Topic introduces two fundamental methods for evaluating investment performance: time-weighted returns, TWR, and dollar-weighted returns, DWR. Time-weighted return measures the compounded growth rate of a portfolio while removing the impact of external cash flows such as contributions or withdrawals. This method is widely used to evaluate portfolio manager skill because it isolates the effect of investment decisions from investor timing decisions. Dollar-weighted return, commonly referred to as the internal rate of return, IRR, incorporates the timing and size of cash flows into performance calculations. As a result, DWR reflects the actual investor experience. The topic emphasizes that both measures are important because they provide different perspectives on portfolio performance and investment effectiveness. The topic explains that time-weighted returns are especially appropriate for comparing portfolio managers and investment funds because managers often do not control external cash flows. TWR divides the investment horizon into sub-periods separated by cash flow events and geometrically links returns across these periods. By neutralizing the effect of investor deposits and withdrawals, TWR provides a more objective assessment of manager performance. In contrast, dollar-weighted returns are highly sensitive to the timing of cash flows. Investors who contribute capital before periods of strong performance may experience higher DWRs, while poorly timed contributions can reduce realized returns. Consequently, DWR is often more relevant for evaluating the overall financial experience of individual investors. Topic also focuses on risk-adjusted performance measurement, which evaluates whether investment returns appropriately compensate investors for the risks undertaken. Absolute returns alone are insufficient because portfolios with higher returns may simply reflect greater exposure to systematic or unsystematic risks. The topic introduces several important performance measures, including the Sharpe ratio, information ratio, alpha, and tracking error. The Sharpe ratio measures excess return per unit of total risk, while the information ratio evaluates active return relative to benchmark tracking error. These measures help investors distinguish genuine investment skill from returns driven primarily by increased risk-taking. Risk-adjusted metrics therefore provide a more comprehensive framework for evaluating portfolio efficiency and manager effectiveness. The topic further emphasizes the importance of benchmark selection when evaluating risk-adjusted performance. An effective benchmark should be transparent, replicable, investable, and aligned with a portfolio's investment strategy and risk profile. Inappropriate benchmarks can distort performance evaluations and produce misleading alpha estimates. Alpha measures excess return beyond what would be expected given the portfolio's systematic risk exposures. Positive alpha indicates that a manager generated returns beyond those explained by market or factor risks, while negative alpha suggests underperformance. Because alpha estimation depends heavily on benchmark quality and factor selection, managers must carefully construct benchmarks that accurately reflect portfolio objectives, investment styles, and underlying systematic risk exposures. Topic also examines the relationship between alpha, hedge funds, dynamic risk exposures, and market timing. Hedge funds often pursue active management strategies designed to generate alpha through security selection, arbitrage, leverage, derivatives, and tactical asset allocation. However, measuring hedge fund alpha is challenging because many strategies involve nonlinear payoffs, changing factor exposures, and illiquid investments. Traditional linear regression models may incorrectly attribute returns to manager skill when performance actually reflects hidden systematic risks or option-like payoffs. Dynamic risk exposures further complicate analysis because factor sensitivities evolve over time as market conditions and portfolio allocations change. Consequently, evaluating hedge fund performance requires sophisticated multi-factor and time-varying analytical frameworks. The topic also discusses market timing, which refers to a manager's ability to adjust portfolio exposures in anticipation of market movements. Successful market timing involves increasing market exposure before favorable conditions and reducing exposure before downturns. While theoretically attractive, empirical evidence suggests that consistently timing markets is extremely difficult. Managers may also unintentionally alter portfolio sensitivities through tactical reallocations or changing leverage levels. Dynamic risk analysis therefore becomes essential for understanding how portfolio exposures evolve over time. Investors increasingly use style analysis and multi-factor regression techniques to evaluate whether performance results from genuine timing skill, changing systematic exposures, or simple market movements rather than sustainable alpha generation. Another major theme is the use of style analysis to evaluate investment behavior and portfolio characteristics over time. Style analysis examines how portfolios align with particular investment categories such as value, growth, momentum, or market capitalization segments. Because factor exposures and investment strategies evolve continuously, static benchmarks often fail to capture the true nature of active portfolio management. Time-varying factor analysis allows investors to better understand shifts in portfolio positioning, systematic risk exposures, and performance drivers. This approach improves transparency and helps distinguish persistent manager skill from temporary factor-driven returns. Style analysis is particularly valuable when evaluating actively managed funds and hedge funds with flexible investment mandates. The topic concludes by emphasizing that performance evaluation must integrate return measurement, risk analysis, benchmark construction, and dynamic factor assessment into a unified framework. Time-weighted and dollar-weighted returns provide complementary perspectives on investment outcomes, while risk-adjusted performance measures assess whether returns justify the risks undertaken. Alpha estimation, hedge fund analysis, market timing evaluation, and style analysis all demonstrate the complexity of modern portfolio performance measurement. Investors and institutions must therefore combine quantitative models with informed judgment when evaluating managers and strategies.